While everyone is expecting central banks to cut rates, something just happened in Canada that's going to flip that narrative on its head. My name is David Quintieri, and what I do here is cut through all the BS and bring you exactly what you need to know. In today's video, we are going to talk about Canada. We are going to look at what's happening in other countries, including Australia, and I want to give you an insight as to what the final solution is. At the very end of this video, I'm going to cover something extremely important, but only those with some actual patience will be able to get that information. Here we go. First thing, Bank of Canada raises policy rate by 25 basis points and continues their quantitative tightening policy. This is important because the expectation was at this point in the year they would already be cutting rates or at least stopping with that. They did initially stop. The expectation was, hey, we're just going to continue this process of like weaning off of that whole tightening policy. That isn't the case. This is what's going on right now. So it is pretty close to where the Federal Reserve is at. At the same time, though, household debt is unimaginable in Canada. You have people that have taken out loans they can't pay back. The only way is that when it comes time to renew their mortgage, which in Canada works like every few years, you have to renew your mortgage, but you pay it over that 25, 30, 35 year, 40 year time frame. Yes, you heard me correctly. And you get to renegotiate or whatever. But what if that rate is going to be higher in the next year, let's say, because depending on when they took that mortgage out initially, a lot of people 2020, they got a 3-year that's coming up right now, or maybe they took it on 2021, or maybe they got a 5-year. Either way, at some point they are going to be paying a higher rate. What if they're in variable, which depending on where you look, could be 15% or higher, 25% even of the total public that are getting these mortgages are getting them at variable rate. They are paying more already. People are paying just interest at this time. And that is a very big concern. Their debt is never going to go down. That is a problem. I talk about this further at the end of this video, where I will highlight the video you got to watch after that to teach you what you can do to make changes with your variable interest rate mortgage, or maybe you got a friend or family member who needs to know that information. So this is what's going on right now in Canada. They are paying too much debt. At the same time, they have way too much, the payments are basically too high in general, borrowing costs. There's another aspect to this. Disinflation hits a snag in Canada. Closely watched measure of underlying pressures reverses in April. So you could see that black line right there. And instead of it going down, it went back up. And that doesn't mean that it can't reverse the opposite direction, but they've been doing so much. They've been trying to, saying, we're going to bring inflation down. We're going to take care of this. And yet they still can't get it down. More data was released, concerns mounting that the pause was premature. GDP, including household consumption, grew by more than expected in the first 3 months of the year, with momentum continuing in the second quarter. Canada's labor market is steadily cranking out more jobs than expected, and the unemployment rate remains near record lows. It's the same situation. Do you recognize this? If I said, US instead of Canada, you wouldn't have known the difference. It's the same circumstance because they all did the same thing. They all printed way too much money, and they all engage in these quantitative easing programs. Most importantly, progress on inflation hit a snag in April as the annual rate hit a key 3-month moving average of underlying core readings reversed course. All they're saying is that inflation went up again. Okay, you can measure this with all these different fancy ways. It doesn't matter. People are paying more for their rent than they ever have in history. People are paying more for their homes, their energy, their cars, like every metric in reality, like you and I would use, none of this PCE and CPI, all that nonsense. What I like to do is take it officially. When I go to buy something, what am I paying? Isn't that the way you're supposed to calculate inflation instead of these crazy metrics that they use? Of course not, because that wouldn't make it their job easy, right? They get it all fancy inside those computers, and they make things impossible for people to understand. And that's kind of the whole point. So basically, housing prices are ridiculous, and at the same time, they're going through this in here saying, at the very bottom paragraph, it says the housing market it hasn't stabilized. It is actually on a complete tear again, something that the Bank of Canada needs to take care of. What are they saying? That, despite trying to bring housing prices down, these interest rates have not done that. And instead, the prices are surging. And what's China doing during this time? As I've said, the same circumstances that they've been going in this direction now for well over a year. China asks big banks to cut deposit rates to boost growth. They may cut their time deposit rates as soon as this week, move to stimulate consumer spending, boost credit supply. As I have said, China is doing a complete 180-degree from the rest of the world. They are loosening, they are pumping, they are doing everything they can. Their real estate sector is starting to decline. You could see the problems with these companies. They're going and trying to get the lending going again. This can't actually be resolved in the way that they would love it to. And so they are trying each and every way. But I see a major concern there, obviously. I'm not going to get away with that. Japan's three biggest banks said that they would raise interest rates for housing loans next month, reflecting Bank of Japan's tweak in its ultra-loose policy. I think it's ridiculous. Anyway, Japan is gone. It will never be again. They will not admit their mistake, and they're still trying to keep their policy super loose. The banks, though, they're tightening slightly. So will that have any impact on the real estate? Well, we'll see in time, but I just want to show you that as well. Australia's economy cools as aggressive rate hikes take a toll. Labor costs rose further last quarter amid inflation challenge. This sounds a lot like what's going on in the United States as well. You're getting some of those economic indicators coming back saying, hey, things are cooler, but interest rates, ultimately, where will they be at in a year from now? That's really the question that the market is trying to ask. If they think that rates will be lower in 6 months, they'll bite the bullet now, even if they lose some money on a real estate investment or a stock investment. But if they thought it was 2 years from now, well, that would be different. They would be putting their money in different places. But they don't believe that. And that's really what the market is showing us here and now. That's real estate investors. Look, if we take any real estate, whether it's Australia, Canada, United States, wherever, look, let's be honest about it. A lot of them have come off their highs, San Francisco and New York, wherever. But think about it. We're talking about something that multiplied, it doubled over the period of 2 years. So if it came down 10 or 20%, it's really not that significant in the grand scheme of things. Those people who bought at the absolute peak, they get screwed over, but it's still completely unaffordable. That's the point. And the whole issue here is, and I'm tired of beating around the bush about it, Buckley's commercial. You know that commercial? Oh, it's awful, but it works. The guy takes the medicine, or you take the medicine, it tastes terrible, but my goodness, it works. That's the whole point of the marketing. And that's what we need. We need that awful medicine to make us better. I called it in my first book, Economic Detox, because we have to shed ourselves of this garbage, of the money printing, of all the debt. We have to get away with that, or else, if we don't, we end up right here in the cycles that I've explained over and over again. When we go down into the cycle, everything follows with it. Just think of it's a wave or something coming crashing down. Well, we can ride that wave down, as a lot of 401k investors do. They ride the wave down. It sucks, it's painful, then we come back up. But instead, we could be doing things with our money during those time frames. I talked about it 100 times. When we saw the tanking that took place in 2020, everybody was saying, I know that the market's going to crash. All of these people out there, the YouTubers, would say, yeah, it's going to crash, but we don't know when it's going to come back up, so let's just dollar cost average. But it's going to be worth less tomorrow and next week, until they were starting to, how do I say it properly, without the censors getting me, without those medical interventions being done, and that would, of course, make the markets real happy. So why in the world would we put money into that? Why wouldn't we have bought, just don't sell, temporarily just buy ETFs that are there to make money when the market goes down, okay, like an inverse ETF. We know that. And we could put little bits of money in there so that as the market is falling, part of our portfolio is coming up, because that will offset said it. It's called risk parity. It's pretty simple. This is something that I've talked about over and over again, and I don't really care if those out there are going to spout some garbage. I'm here to just give you what's real. And the reality is not very nice, is it? Is it? You tell me. Look here. Slowdown threatens Indian economy even as its rich keep spending. Hey, doesn't that sound familiar? Growth is expected to decelerate sharply this fiscal year. Consumer demand is weakening among the middle class and the poor. A lot of that actually is happening in other parts of the West that I've noticed. But you could see it here. India's central bank is the most bullish on the country's growth prospects. So we can compare for a lot of these different companies and what they have said. Well, the central bank obviously has to do well for their own country. I could understand that. The point is that if we take it for what it is, we need to understand that India is going to have a lot more growth than some of the developed economies, but it's still something that is extremely difficult to manage. India, you got a population 1.4 billion. How do you manage all that? How do you take care of that growth? How do you feed everybody? It's just extremely difficult, and that's really the challenge going forward, not just for now, but for 5 years, for 10 years. India has great prospects, but it's a real big difficulty that they have. They have a growing population, which could be beneficial, but it can also be a hindrance, right? It's not just one way or the other, but they've got a lot of consumption that's happening. A lot more people are moving from the rural into the cities, and their manufacturing and logistics have improved. They have improved over the years. So there are opportunities for investors for India. A lot of businesses, you can use India for manufacturing. If you're manufacturing leather, if you're manufacturing steel, textiles, these are all things that India is good at, and they're getting better with the logistics. So exporting those out, maybe you're in the UK, maybe you're in Canada or the US or so on, you could take advantage of that. Okay, now the individuals who were smart enough to stay until this part of the video, you're going to get some real good stuff coming up in a minute here. Interest-only loans helped commercial property boom. Now they are coming due. Landlords face a $1.5 trillion bill for commercial mortgages over the next 3 years. Interest rates are going to punish these companies and the investors that are along with this. So you got to follow the money here, because we're talking about what's happening with individual investors. We're looking at homeowners. They're all getting hurt right now. And my goodness, commercial real estate is the worst, by far the worst position. Stay clear of this. This is my warning to you. Stay clear of anything to do with commercial property until rates start getting cut. At that point, then you do what you want. But I'm here to tell you, watch out for commercial real estate and any company that's exposed to commercial real estate, okay? Struggling companies that got debt lifelines are failing anyway. And the whole point of this article, let me just summarize it for you. Companies that were struggling, they get some money and help us, because we're gonna do better, we just need to fix it. They never do. They never do. It's just like that degenerate that goes and gambles and he says, look, okay, I made a mistake, I shouldn't have gambled, look, just help me out, I'm gonna be okay. And then what does he do? He just gambles it away again, or he throws it over here and is lost. You cannot fix what's broken in this case here. You have to wipe it out, economic detox, let it go, and start from scratch. That's the only way. You can't put a bandage over a gunshot wound because you're not going to be saved, let me tell you that. That's what's going on right now, and it's the exact same thing with countries. That's the reason I bring this up, and we're dealing with that today. What's happening with the money? We follow the money and we see Singapore getting massive deposits in their banks right now, because those probably most investors being in Asia, they're looking for a safe place to park their money. Singapore banks, that's where the money's going, all right? And then we have this universal basic income to be trialed in England. They're going to get £1,600 a month for 2 years. Sign me up. I'd like to take that. £1,600. That's a lot of money, okay? And this is the solution to the whole circumstance. We're going to pay everybody money for doing nothing, and we are going to encounter much more inflation. The inflation is going to get so hot, and that's why you got to deal with these circumstances yourself. The government is going this direction. They're going to put you on a universal basic income. They're going to force feed you the central bank digital currency, and you're going to be stuck. You have to get around this. I'm telling you right now, this is the ultimate solution that they have desired, and they are going towards it. Do you see how the economies are weakening globally? They're increasing interest rates. Borrowing costs are real difficult for a lot of people. But what do you do as the individual? Look, those people, let's just say Bezos or what have you, this guy was able to take out loans on his stock in Amazon at 0.69%. You could have done something similar to that if you had Interactive Brokers as your brokerage for stocks. People always ask me what's the brokerage of choice. Interactive Brokers. I'm not affiliated, but I do use them. And basically, they were given what was it? Maybe about 1%. So you could borrow. I wouldn't suggest this, but you could borrow at a 1% from your portfolio. So you're going to be borrowing at 1%. What can you do with that? You can make an infinite amount of money when you're borrowing at 1%. So these people, they had years and years and years to get all that money, to borrow what they needed, to take advantage of that. And now they increase rates. They can kind of sit back and watch and wait for interest rates to go back down again. They're all good. They have more than enough time. But you, the individual, you're trying to keep up with it. You can't. That's the difference. The richest of the rich get to take advantage. Not Bezos. He's, only on the Forbes 500. Those are like the low-level rich people. But the point here is that we have to watch out. We have to understand that rates are likely not at this time, not done, but where we can see them in the next 6 months or so, that's a different story. I want to keep a close eye on this. Every single day I bring you the latest and greatest information. This video right here is what you got to do if you have a variable mortgage or know somebody that does. Hit that thumbs up on the way out of here, okay? I really appreciate that. Click this video and I'll catch you over there.